What's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. And in this video, we're going to be talking about how you can go about choosing your options. When you're picking your option trades, you have a lot of different choices to make outside of, picking the stock that you actually want to trade options with, and then also the expiration date. So do you prefer to trade in the money, out of the money, or closest to the actual stock price at the money? Now, obviously your goal as a buyer is to have the option be in the money at expiration. So the option that you pick is really going to depend on the amount that you want to spend, your risk tolerance, and your expectations for how the stock price moves. So if any of this sounds like Greek to you, no worries. We're going to go through this piece by piece, okay? But first, if this is your first time watching this video, please make sure that you click that thumbs up button. It really helps the channel. Also subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. And with that, let's get into it. First, let's do a breakdown of moneyness. And when we talk about options being in the money or out of the money, these are basically different degrees of moneyness. And moneyness is used to describe the intrinsic value of an option contract and how the strike price compares to the actual trading price of the stock. So the premium price that you see for your options is made up of intrinsic and extrinsic value. And we've talked about this before, but the difference between intrinsic and extrinsic is already profitable. So it's the value that an option has if you were going to exercise it today. So if you were actually going to buy those 100 shares, then this is your intrinsic value. This is the value it has right now. Extrinsic value doesn't have as much value, okay? If your extrinsic value was to expire today, then you wouldn't make any profit with it. So essentially it's worthless. Remember this, in the money options have intrinsic value because their strike price has an advantage over the actual stock price. And out of the money options only have extrinsic value, the value of time and speculation. Back to the different degrees. There's three different degrees of moneyness, and that's in the money, at the money, and out of the money. And in the money option has a strike price that's already been passed by the current stock price in the profitable direction. All right. So calls is going to be below the stock price. For puts is going to be above the stock price. In the money options are going to move more like an actual stock position because the more in the money options have higher delta values, and delta is going to be the measure of how much your option price is going to change based on the movement of the actual stock price. Now, this is going into the option Greeks. I'm not going to go into it too much. We actually have a video on it, so I'm going to link that below. Make sure you check out that option Greeks video. Just think about it like this. Actual stocks have a delta of 1. Options are derivatives of stocks, and they have different delta values. So it could be 0.1, it could be 0.2, 0.5, 0.7, so there's different values, but the actual stock has 1. High delta means that there's a better chance for the option to be in the money at expiration. So that's why you'll hear a lot of people talk about it percentage wise. Now, this is something that's pretty interesting, but buying options that are really far in the money, it's basically going to have a similar profit opportunities dollar wise in just buying the actual stock. All right. So you see Amazon right now is trading at $3,372. Okay. Now, if we were going to look at the options and we were doing calls, looking at our delta value, the further in the money we go, the higher the delta. Okay, so this option would basically cost you $1,000, okay? But because of its high delta, however much the stock moves, you're gonna make that amount times 100 because this is gonna give you control over 100 shares. And Apple's actual stock is trading at 149. 149 times 100, that's 14,000. Yeah, that's not even a comparison. So basically that just means even if the actual stock price doesn't move much and you hold your contract open through expiration, you can still sell that option and still collect the leftover intrinsic value from the profit that you would make selling it, whatever the stock price is, market price. In the money options are also noticeably more expensive than at the money and out of the money contracts because of their inherent value. And with higher delta values, you're going to gain a lot more profit when the stock moves in your favor. But then also at the same time, you can lose a lot more if it moves against you. An out of the money option is one that has a strike price that the stock price hasn't reached yet. Out of the money options are a lot cheaper than at the money and in the money options because they technically hold no value. So remember, like we said earlier, if you held an out of the money option open through expiration, then it would just expire worthless and you would lose your full premium. Out of the money options also have a much lower delta value than the other options. So you're going to need larger price jumps in the stock price to see good profits with out of the money option. A large stock move in your profitable direction can give you big gains. And then at the same time, if it moves against you a little bit, then your loss is still going to be less than it would be if you had an at the money or an in the money option. And then lastly, at the money options. At the money options have a strike price that's equal or closest to where the stock price is. Also, these options are going to have the highest amount of uncertainty because they literally could go either way, and they're going to be the most affected by time decay. At the money options can sometimes be one of the worst positions for you if the stock moves against you, but then they can also give you huge gains with just a little price movement in the stocks. All right, so I know the real question that you have is which one of these is going to give you the best return? Is it going to be in the money, at the money, or out of the money? Which one should you choose? Well, the first thing I'm going to say is it really all goes into your strategy. I'm going to show you a live trade example of having 3 different options open. We're going to do it on Thinkorswim and how differently the strike prices affect your profits, okay? All right, so this is just a Thinkorswim. We're using October 14th as the date, and I'm going to use a 30-day expiration, so November 19th. All right, and these are going to be our strike prices right here. Far in the money is going to be the 135. So the 135 strike price, that's our in the money. Our at the money is going to be the 140. And our out of the money is going to be the 150, okay? And I'm setting all of these to market so I can just go ahead and get in. I don't want to worry about limits. And so you'll see that they all got filled. Go into the monitor tab, and these are going to be our list right here. So I'm going to have it listed out, the ones that are in the money, at the money, and out of the money. And then right over here, this is going to be our profit panel. So this is where you're going to be able to see how much money we have made. Okay. So let's press play and let's let the day, move forward just a little bit. And you'll see already, oh, wow. So looking at the stock chart, this is just, a short term, how much our price has gone up from 141 to 142 in the day. So obviously the one that's making the most is the in the money, but let's go ahead and I want to fast forward this to the 18th. So just a few days. Now I already know hindsight's 2020. I already know that this stock is going up, but we're just going to kind of see what happens with our different strike prices. So you see here, we're on October the 18th and the stock is still moving up today. But this is 9 o'clock in the morning. Let's change it to the afternoon and you'll see again, the stock has continued going upwards. So this is just a few day span of, how long we waited. So this has been a few days from where we entered. So you can consider this a swing trade, and let's go back and see our profits. So you'll see on a longer hold, the one that has the most money is the in the money. At the money is a little bit less, but the one that's received the least amount is the out of the money with more time. Okay. So let's just reset this, and I want to show you an example with a day trade. So let's still use October 18th. Let's just go to 8:30 this morning. The stock is obviously it's doing well. And we're just going to use the same expiration dates, about 30 days away. Now I'm going to use the 142 for my in the money strike price. Okay. I'm going to use the 143 for the at the money strike price. Change it to market. Okay. And then for the out of the money, I'm going to use the 145 strike price. Okay. So we have all of those. Check on the monitor. Boom. Okay. One more. Boom. Okay. So everything is done, and looking at our profit and loss short term. Okay. Well, the out of the money is moving, more than either of them. So these are our profits here, and you'll see we're profiting more with our out of the money. Now this is just for a day trade. And we've gone from 143 to 144. Now the other ones are kind of catching up. But let's just go to the end of today for that day. And we already know the stock just did crazy bullish movement, strong uptrend. Now let's see how our options played out. All right, so you see that all of them did well. The one that did the most was in the money, but what's interesting is for a short-term trade, the out of the money is still pretty profitable, and it's a lot cheaper. It's about $200 cheaper. Now, just leaving out expiration dates and looking strictly at strike prices, the first step for you is going to be to calculate how much money you're willing to invest into the trade. So what type of options are you going to want to look for anyway? Then find your target price for the actual stock price. What's the target price that you think the stock is going to reach? Is it close to its all-time high? Is it rebounding from that? And then also a guesstimation of how long you think it's going to take for that stock to hit your price. So all of this is going to go into the options that you pick. From the example that we just saw, out of the money options are going to perform better in situations where there's a huge move in the stock price in a short amount of time. For out of the money options, you're going to want active stocks with regular large price movements or big news catalysts. Now, if you're expecting a small move in price, then in the money and at the money options are going to be your best choice. Also, if you're expecting slow growth in the stock over a long period of time, then it's also going to be better for you to pick in the money options. So whether or not you're bullish or bearish on a stock, it's really going to help you to have a good idea of when the stock might hit a certain price. One way that you can go about doing this is looking at stocks that are trading in a clear trend or a clear support and resistance area. So you can plan it so that you only trade stocks with clear support and resistance zones to kind of help you gauge your trades. And, you know, just as far as expiration, short-term options can experience higher losses even when the stock price is going really high. Now, buying further expiration dates gives you more time for the option to move in your favor. And then, of course, you can exit your position earlier once you've gotten your profits. Make sure you check out this playlist that we have on option trading so you can just kind of go through and see some of the different videos we have on options, open interest, volume, how to search for options on Thinkorswim, all of those different things. So just check out some videos from there. So make sure you check those out, all right?